thanks everyone for joining us. This is the last week in Mortgage Today, minus TMC's fearless leader, Rich Swerbinsky, who happens to be on at least one and probably more than one plane on his way back from San Diego to Cleveland from IMV today. So super lucky. My name is Faith Howard Mooney. I'm the VP of Member Engagement here at TMC, and have everybody on my team knows one of my favorite people within network with me today, Craig Ungaro, who is the COO of Annie Mac Home Mortgage. So Craig, thanks for doing this with us today. Appreciate it.
Of course, absolutely. Appreciate you having me on.
And I'm going to throw it out there because none of us can believe this on our team, that Craig has not done the last week in Mortgage Today before. That is unimaginable to the rest of us. So we are, the two of us together are going to kind of punt it today and kind of see where we go. So we were talking a little bit earlier. First thing, everybody in the chat, we want you to communicate with us while this is ongoing. So definitely send some chat messages. If you have predictions for the Super Bowl, Craig's team is still in. He comes from, they're in Mount Laurel, New Jersey, right? Is where Annie Mac is headquartered, and the Eagles are still in playing the 49ers on Sunday, as well as I just saw something Go Birds.
Go Birds
on there. So yeah, so you got at least one person in your camp here on the call today. So oh, there's also a 49ers fan.
Fine, Angie. It's fine.
So get us started a little bit by just sharing with us Annie Mac Home Mortgage, and kind of, I see you in our market as always growing, emerging, being in front of technology and all those awesome things. Share with us kind of like who Annie Mac is right now and kind of what you got going on.
Yeah, so for those not familiar with Annie Mac, we're a mid-size independent mortgage banker located in Mount Laurel, New Jersey, just outside of Philadelphia. We are primarily a distributed retail sales organization. So we have branches across the country, mostly on the East Coast, up and down the East Coast. And we have some other areas in Ohio, Indianapolis, Colorado, Texas, but for the most part, we're up and down the East Coast. And distributed retail model is our primary focus. We have been fortunate in growth. Of course, we've contracted overall volume last year, as the industry has, but we continue to be very much in growth mode. Recently, we partnered up with another company in the Virginia Beach area, so that was one of our growth strategies, was some merger and acquisitions, and we continue to have some conversations along those lines. And really, our focus for growth in 22, we did sort of an about face where we would typically grow through expansion. And we would just continue to expand from a geographical standpoint. In 2022, somewhere around May or June, we focused really primarily on feeding the existing branches that we had. And so really just going after particular producers that fit our model and that would align really well with existing branches that we had. And that was, it was definitely challenging because it's a different model for us, right? A recruiting model, I mean. But it's had its success, and our commitment. Really, our CEOs continued to say, like, we're committed to our branches, our current branch managers that are here, our loan officers that are here, and we're going to make sure that we're the best. Growth is very challenging at a time like this. There are a lot of people out there, big signing bonuses and trying to, grow through signing a check. And, we decided to, hunker down a little bit and focus on what we have, kind of weather the storm, if you will, and really focus on, our mantra for the last 6 months has been be in the fight with our loan officers, meaning, our initiatives as an organization, I continue to be very focused on giving our loan officers what they need to be successful in winning the deal. And that's really been sort of a top-down approach in back half of 22, and it continues in 23.
Yeah, definitely. It's a hard market for everybody right now. We have heard some things that, it used to be, I think, that we would always just hear that people are chasing the money.
Mm-hmm. Yeah.
They're going to move around, they're going to chase the money, they're going to demand these high salaries and everything. And we are seeing a little bit of change in hearing it from some of our lender members in network that, There are a lot of people out there right now who have kind of reanalyzed things after the last several years that we've had, the good and now, the opposite side of that. And they're looking, even on the LO side, more looking for culture.
Yeah.
Where do I best fit? Where can I thrive? Where can I still have my life with my family? All of those types of things. So it's interesting to hear that you guys, took a stance and kind of went down that path. Um, so let's kind of get into some things here. One of the things that jumped out at me when I read it today, it was something that you guys did very early on. It also came up on, we had an owner operator call within the organization, and it came up on that call this week that people were still looking to do some of these things, but office vacancies at the end of 2022 are lower than at the pandemic's vacancy rate at the height of the pandemic,
Yeah.
at 18.7%, which, we're hearing differences of people. I think your model is hybrid, if I remember right, but you did some interesting things at the beginning
Yeah.
stages to deal with office space. So can you just kind of comment on kind of like what you've done related to that? And it may spark some interest from other people on the call as well.
Sure. Yeah. I'll start off by saying I'm not surprised by that. I know that the headlines will catch some attention, and typically that's what headlines are intended to do, right? It's,
Yeah.
click on, read some more, look at our
Exactly.
advertisers, right? Read more. But there, and I think it makes a lot of sense if you just think about it a little bit. And I didn't read that particular article, but in 2020, and when people weren't going into the office, it's not like you could just get out of your lease at that moment in time, right? You have a lease
Right.
term. And so you have this sort of wave of people exiting. So if you could survive 20 and 21 in a hybrid model, much like we did, when it was time for renewals, you didn't renew as many places, or you downsized, or you moved. And so that doesn't really surprise me. I mean, in 2020, we had to go remote, right? 100% remote. It was just a requirement. Fortunately, we were already a hybrid model. Actually, one of the reasons I'm in the position that I'm in, and moved from, I don't know if you know this or not, but I was originally a compliance officer, and I moved into operations, which is a very unorthodox sort of shift. But the reason for that was because we were really just trying to get through all of the compliance changes that happened in the early, 2010 to 9, 10, 11, all that different. And one of the things we took that opportunity then to say, let's not be geographically driven on human capital resources, right? And the reason for us was because we're in Mount Laurel, New Jersey, which is like a little hub of mortgages. We have
Right
Freedom
down the
Mortgage
street.
nearby.
Yep.
Yeah, BHH down the street. And so how were we going to compete? And we were going to compete by being able to go maybe outside of our area and offer this hybrid environment, this remote environment. So when 2020 hit, we were already technically prepared for it. So then it was just a matter of laptops from that point forward. And once we were able to successfully get our people working well from home and get through all the security concerns and access concerns, then we were growing, right? Everybody was growing. And then so we had to hire again, and you just continue to expand your footprint from where you would hire people from. And so now that we're getting back to normal, I'm not going to get rid of good people because they can't come into the office. And so, for us, that really, it was just very clear to us that we're going to find a new way to work in this environment. That being said, culture is really, really important to us. And I wouldn't be lying if I said that our culture has taken a hit as a result of that. And we really have, in 23, have really revamped sort of how or at least we're trying to revamp how we're staying engaged with our employees, because that is a concern of ours. I would be lying to you if I said, yep, we were able to go remote and we didn't miss a beat, and there aren't things that people miss, because there are. And so we're still working. It's a work in progress. But it's not one that we're debating saying, are we going to bring everybody back in? It's off the table completely.
Wow. Wow. It's interesting. People, it seems like there's a lot of hybrid out there. And I
Yeah,
think people have kind of taken advantage of that and used that, especially in a culture environment, to retain staff, the staff that you
yeah,
want to keep. But yeah, it is interesting I mean, people used to say that mortgage couldn't be done that way, or certain roles couldn't
sure.
be done that way. And it's been a great thing, I think, overall for our industry, because it's allowed people maybe a little bit more flexibility in what they're able to do with their families and
Yeah.
things, at least on some days of the week. But yeah, so if anybody has any feedback on that, please share it with us. What are you doing? What are you doing in your office? What do you like about it? What you don't? I think almost everybody struggles with the culture thing when you're not together. We've always been a completely remote company. So we don't have a headquarters office. We've never had an office. We crash at Rich's house every once in a while and all get together there. But
It's great.
yeah, but it's we've always been that way. And I think it's hard sometimes because you really want to see the people that you work with. So we've taken advantage of Zoom and some of those things, but we do have some resources that have been brought up if people are looking at the office space situation to be able to help you. And yep, Amy, you are exactly right. Speaking of conference is our culture.
Nice.
Being together, talking together. We have a conference coming up in March in San Diego. So anybody on here who hasn't registered and is planning on coming, here's my shameless plug to get you going. And Angie just posted the information out there for you. Let's talk a little bit about inventory before we hop into other things. So total housing inventory, lowest, weakest since 2014, probably not a surprise to anybody. Under a million, inventory levels under a million in December. Is where you're at in the markets that you serve, are you seeing that same thing still
Yeah.
kind of happening in those markets?
Yeah, absolutely. So we start off, we're saying commercial inventory high, residential inventory low, right? And so
Yeah,
that's
exactly.
definitely the way the pendulum is swung. But yeah, no, I mean, you know, we everything was slowing down towards the end of 22. And there were various reasons for that, right? Volatile interest rate environment, seasonality, which naturally happens, right? So there's all these different things. And, you know, as we came out to new year, we're seeing activity pick up, but it's not necessarily resulting in applications. Applications meaning homes, transactions, you know, people winning bids on homes, and that's really a result of supply, which you just mentioned, right? That the inventory is the big issue there. So, you know, I would argue that even if interest rates remain where they are, they didn't move up, they didn't move down, they stayed where they are. You know, so inventory is really the last piece to solve the purchase market issues that we have.
Yeah.
And so we do see that. And where we see it is we measure our credit pull activity, and we measure how many pre-approvals are out on the street, so to speak. So if you know, take a borrower's information down and you run it through, we have two paths, right? One is you just sort of the loan officer gives a pre-qualification. Another path is you collect some documentation. Our underwriters will underwrite in advance of finding a home. Those metrics are up over, even sort of from a trajectory standpoint, better than last year. Whereas the application data, which is when a borrower actually now secures the home and the application is complete, that has been flat over the last 3 months. And so, you know, you can't run a business on hope as a strategy, all right? But you can have faith. No, but you know, we do believe that to sort of start thawing out, and really we're sort of eyeing up that President's Day weekend is typically when you start seeing more of that. But there are definitely some things that can sort of get in the way of that happening, and really all we can do as a mortgage operator is continue to work on the controllable items, not necessarily the ones that aren't. So a company of our size, and we're pretty proud of the growth that we've had, but still in the grand scheme of things, a very, very small market share of the overall mortgage business. So there's plenty of pie to go around. And if we can sort of expand ourselves and grow, we'll be able to sort of overcome any of those economic headwinds that we get headlines on.
Yeah, any great ideas out there? I know that it's always talked about on everything to do. What's the answer, right? What's the answer? I just experienced it myself in looking for a new home and finding none on the market in the places I wanted to be in, but using my resources internally to find one home, which yeah, so I just recently experienced that. What do you think the break point in supply? What's the answer out there? You got one for us?
No, I don't. Unfortunately, I don't. I mean, it's one, it's definitely regionally driven, right? So, you know, you could see certain areas like Arizona being much different than, you know, a metro area on the East Coast, possibly, right? So there's definitely different factors, you know, just the way sort of we're migrating as a society to different parts of the country. That's going to play a major role. Where you can build, right, is a big factor, and builder confidence obviously plays a big role in the supply. So, you know, I think that the more stability that we get as it relates to Fed activity, that will definitely help get us back to a little bit more of a normalized seasonal curve that you would see. So when I say like we're waiting for President's Day to occur, there are things again that can disrupt that completely. But the more we're sort of stable and the more that people feel like, okay, as rates continue to shoot up, people are just going to kind of stay on the sidelines, wait to see what settles out and see. But if things remain stable, I think might see more people getting into the selling side of this, and that would be very healthy for us as we get into the second quarter.
And definitely in my career, I mean, rates have been a lot higher than where they're even at right now. February 1st, I think, is the date, right? That we're all waiting for to hear, is it a quarter? What is it?
Yeah.
Any predictions on your side and what you're hearing in your world on what you think it will happen with rates at that point? Do you think it's a quarter?
It may be, very well may be. I think the Fed is very committed to getting inflation down. I don't know that they're going to be able to get it all the way down to the 2% that they want, and I don't know that interest rates, that lever is going to get them all the way there anyway. But it depends. They're going to continue to be very hawkish on their language, so maybe they're not as aggressive on the actual like move, but they're aggressive on their commentary of it and what they're willing to do and kind of scare the US consumer into, getting inflation down. And so, again, there's just so much, there's only so much we can do as it relates to that activity. And, I can tell you from AnnieMac's standpoint, we looked at this year and we have 3 sort of strong probabilities, not equally weighted, but 3 strong probabilities. And, the one that appears to be playing out is the one that we're probably most excited about. I know most people would say, I want to see rates shoot down and go back down to, 2021, 2020 levels. We're not in that camp. We don't think that's the path that we'd want to pursue. I mean, in the short term, I think everybody would like it, but in the long term, it may prolong some correction that needs to occur, right? So for us, it's slow and steady is not the worst thing for our industry. But you have to operate well as a mortgage company in order to win that slow and steady battle. And that's kind of the path we hope occurs. We think it's the most likely to occur, and that's the one we're mostly prepared for.
Yeah. I mean, interest rates could go all the way down to 2 and 3, but if you don't have houses for people to purchase, I mean, that isn't necessarily the quickest. I mean, it's a quick fix for some people.
Yeah, refinances would be beneficial there, right? You would have a mini refi boom. You would basically refi everything that just originated last year, and that would give a little like a sugar high to the industry, but that wouldn't really fix anything. And I think really it's not about the level of interest rates for the health of mortgage companies as much as it's the pricing, right? It's the liquidity in the MBS market. So, the more that rates are volatile, the more people are going to stay on the sidelines from an investment standpoint. And, that's where so not only are volumes down, everybody talks about interest rates and volumes, but margins are down as well. And so that is really a struggle. And I know that one of the topics we were going to talk about is the CFO.
That's a great transition there that you just did.
Exactly. And I couldn't agree more, by the way. So I'll let you sort of speak to the headline, but it kind of dovetails. Yeah.
The headline was the Rocket CFO warns against reliance on MSR sales at the end of last week.
Yeah.
So
I see some similarities. See some similarities between mortgage companies and the US consumer in that, both kind of went into this difficult environment with healthy balance sheets, and they continue to sort of draw down on them. And that's kind of where everything's going to flush itself out. And, I do agree that you have to be able to operate in this environment. Nothing is to say that this in some ways isn't the new normal as it relates to the pricing the MBS market. There is no guarantee that 105 comes back. There is no guarantee that those things happen. So, if you're sitting around just trying to wait for that to come back, I think it's a fool's errand. And I think, you need to be a little bit more responsible in your approach towards moving forward. So how do you do that, right? How do you prepare for that? It's lowering your cost model, right? And this isn't stuff people want to talk about because, a lot of times in the mortgage industry, it affects people. And there's good reason to sort of feel like, you don't want to publicly talk about that. But, that's something that AnnieMac did, we were very serious about in the end of 22 and prepared ourselves. And something we're very committed to is making sure that we can provide value without sort of just always being so reliant on growing human capital infrastructure. And I think that's how mortgage companies have to operate and think moving forward. So a lot of adjustments. It's not just headcount thing, but it's a compensation plan thing. It's alignment about company goals and how you compensate. And there's a number of different things, and, really evaluating how we operate as a company, where we can be leaner, where we can be smarter, where we can cross train. All of those things are on the table. And so for us, you can't continue to rely on your MSR, right? I mean, it's only so much of that to go around, and any sort of interest rate changes or market changes could even affect the value of those things. So you do talk about in a place in which rates do start to come back down, and that can be off the table as well. So a lot of moving pieces.
Lots and lots of moving pieces. One other big moving piece were the changes to mortgage costs that were announced last week. Essentially, I don't know if you'd call it a penalty, but
Yeah.
I mean, what do you call it? I don't know.
Unintended consequences, what it is.
Maybe that's what you call it. Any feedback on those changes that kind of happened, and the impact that you think that they will have?
So specifically about LLPAs and the adjustments, I mean, I empathize with policymakers because I am one in my organization, right? And so what I mean by that is you can look at every rule and sort of sit on the sidelines and critique it. So, but as a policymaker within my own organization, I do try to approach each one of these scenarios with a little empathy and say, okay, what's the intention of this? And then the unintended consequences that come from it. And so, I think the intention's there. I have a great deal of respect for the director of FHFA, Sandra Thompson, and I've spent a lot of time listening to, Fannie Mae leadership, Freddie Mac leadership, and I get it. I understand the intention there. It's a really, really tough thing for us to execute well. That's the challenge. So I'm not being critical of the rule at all, or the modifications and changes. I think it's intended to do the right thing, and I think we're really going to be challenged as an industry. I can tell you we're racking our brains over this one. And just specifically for everybody that's listening, we're talking about, how DTI can impact pricing, and not just like a quarter on price. We're talking big changes in pricing as it relates to what the DTI of the loan is. DTI can be one of those things that's a little subjective, in that an underwriter may or may not use certain income based on its likelihood of continuation, or how long it was there. So these things aren't black and white, and but the rule is, right. So if you're at 40 DTI, it's one pricing. It's 40.1, it's another price, and it's a big swing. So we wouldn't maybe have as many challenges with this if our redisclosure rules weren't so strict and there weren't so many interpretations of those rules too. So what I mean by that is, if you believe it's a 39 DTI, hypothetically, you price it a certain way, and then underwriter gets a hold of it and it's a 41 DTI, price changes. Is that a valid change of circumstance, right? That's sort of to debate. Should you have known that better or not? And so if you go under the assumption it's not, and by the way, the judge and juror of who is that a valid change of circumstance is so many people. It's not even like a single source, right? So you could have any state can come in and interpret it a certain way. Any agency can come in and interpret it. Every single loan that you sell to an aggregator is going to interpret a certain way. So you can see sort of the execution challenges that come here. So let's assume it is not a valid change of circumstance. Now you have to figure out, do I need to underwrite income in advance? Once you get the documentation, do I need to have an underwritten loan before I lock a loan? And so these are the challenges that are very relevant and very top of mind for us. And our senior leadership team has been spending a lot of time on this topic, more than we imagined. And so it's live, it's here, it's in front of us. So a lot of work to do and a lot of challenges ahead of us.
Yep. And one of the things that kind of popped out at me when I saw this last week was, well, so does that mean that the process becomes a little bit longer because of some of those situations? I mean, what does that do to impact the process and just moving things through your pipeline as quickly, as a lot of people have in the last couple of years?
Yeah,
I'm sure as the COO, that's on your mind too.
it is, so for us, like I mentioned earlier, we call TBD underwriting, which means underwrite prior to the property being found, right? The pull through on those is like 25-30%, right? Somewhere in that range. So that means that for every 10 loans that an underwriter looks at, only 2.5 or 3 of them are actually going to close at the end. And that's elective, right? So that's a service to our loan officers, so they have a level of confidence to issue an approval while the borrower is shopping. It's a great service, it's value add. A lot of people participate in it. Not everybody participates in it, but now you almost create a situation in which you might have to always do that. Now think about what your
Right,
pull through is. Like our normal pull through from
right.
underwrite to close is like 80%. In this elective service, it's 25 to 30, and we're okay with that because it's elective and it's not being used. Maybe 10%, 15% of our business goes down that path. Well, if 100% of our business is going down that path, that really changes the cost to originate, and obviously somebody's going to
And
pay
who
for that
usually
too.
pays,
And
I was gonna say, who usually
yeah,
pays what that
right,
cost is? It kind of goes back to, is this another cost that eventually is gonna be
yeah.
passed on, have to be passed on to the consumer?
Unless another organization finds a better way to do it without having those costs, and that would then become a competitive advantage for them. And that's ultimately my job, is to make sure we optimize the
I was gonna say, I
workflow
can
and
see your
ensure it
brain
doesn't become a
working.
cost. Yeah.
Yep, Craig's brain has been working on that one already. Well, believe it or not, we have 3 minutes left.
Oh, all
It
right.
goes by so
It
fast.
sure
So,
does. Yeah.
topic that you'd love to talk on before we go, growth strategies for this year, maybe? That's a hot topic within the market?
Yeah, I mean, one of the top, so growth strategies for this year are going to be, we'll probably start to get back into expansion geographically. I remember earlier in the conversation, I was saying that we really have spent a lot of time reinforcing and adding resources to our existing infrastructure. And this year, we do plan to sort of expand back out in the second quarter, but we feel very strongly about the type of relationship that makes the most sense to us. And we definitely think we'll be doing a lot more of the same type of recruiting efforts that we did in 22, which is very strategic, and where we can put all of our resources towards something and get more bang for our buck, in terms of volume and synergies. So we'll continue to be strategic in that space. And then the other areas that we plan to continue to grow is our consumer direct area. We've really put a lot of effort towards digital marketing and being able to reach consumers in a digital level, which is much different than our natural habitat, which is distributed
Right.
retail, boots on the ground, referral business. We've had some success at the end of 22, testing out some different methods, and we plan to expand those, which is pretty exciting, especially for me.
And consumer direct, do you see, just like curiosity question, do you see consumer direct? I have kids in their 30s,
Mhm.
so consumer direct, that is how they operate their whole entire life.
Uh-huh. Yeah.
So is that part of the strategy related to that? Is that, first time home buyer coming in probably is someone in that generation and operates maybe more effectively that way themselves, even if we
Yeah.
don't?
I think that's right. I think providing information is very critical to today's consumer. And I don't think it's just the younger generation, although I think that is where it will primarily be
Driver.
used. I do think there's a lot of highly educated, financially sort of savvy individuals that are okay, that maybe have gone through a mortgage multiple times before, and they don't feel the need to have to go through the process, And so, and I mean, the process is the human interrupt. Some people are very busy. They don't want to, they don't want to transact where they have to take time off from their day-to-day job to do things. They want to go home at night, 9 o'clock at night, and do what they need to do, and feel comfortable doing it. So I do think there's a bigger population of people that will relate to that. And we just want to make sure we have a seat at that table. So by doing that and expanding into it more, we're not sort of making a bet on one or the other. We're simply just saying we want to participate in both segments.
Yeah.
And I think the consumer direct one it has been under represented by us. And so that's one of the other growth strategies as we go into 23.
Yeah. I just uploaded all my docs in 15 minutes this morning. I haven't met anybody that I'm
Yeah,
working with. It doesn't matter. I mean, but again, comfort in the process and
sure. Yeah.
kind of been through it a number of different times before. But well, this has been so much fun.
Likewise. Yeah.
We're already at the end of the half an hour, which I find really, really hard to believe. Your first time was painless, right?
I think so. Yeah, it was great. I enjoyed it. I could have talked to you for another half hour.
Exactly, exactly. But we so appreciate you being willing to do this, even when you were traveling today.
Not a
It means a
problem.
lot to us, having Annie Mac in our network. As always, we always love it, and you guys contribute so much to the rest of our TMC family. So You've got some great comments.
Oh,
on
Allie,
this.
how you
You're a great,
awesome,
you're a great
awesome.
speaker. So I agree completely. And thank you for doing this with us today. We really appreciate it. For those of us who joined us today, or those of us listening on podcast, which is where this is viewed probably the most, join us sometime live. Rich will be back next Monday at the same time with the Last Week in Mortgage Today. Thanks so much, Craig.
Thank you. Bye-bye.
Bye.